Welcome to Opalesque TV. Today we have John Goldberg, founder and CIO of BBL Commodities, a hedge fund that focuses on oil and natural gas commodities. Now, John, can you introduce yourself and give us some insight into your background and how you got started with your firm?
I started my career in oil and natural gas in 2003. My first job was at Aron, which is the commodities group within Goldman Sachs. My first role within Goldman was working with the firm's clients, working with both consumers and producers of refined products on their hedging transactions. Learned a lot about how the shape of the futures curve moves, learned a lot about the fundamentals of the oil market. I wanted to move into a pure trading role, and I took over a prop trading responsibility for my last 3.5 years within Aron. After doing that, I moved to Glencore in 2010. Glencore at the time was still a private partnership, trading a lot and moving a lot of physical oil with some very talented physical oil traders, but they wanted to build up their financial trading expertise. So I joined Glencore and worked there until 2013. I'd always had some interest in starting my own business and starting my own fund, and was able to bring in some investment from some of the individuals that I had worked with, both at Glencore and in the oil industry, as our sort of day one capital. A few of my team members from Glencore came and joined as we got the business going, and we started trading in the fall of 2013.
So, John, give me an overview on your strategy and what you do on a day-to-day basis.
BBL is a relative value oil and natural gas fund. By that I mean the bulk of our trades are in not investments that play off of the direction of the price of oil or of natural gas, but on things like the shape of the curve, or trades that are a view that one part of the petroleum complex will outperform or underperform another part of the petroleum complex. In my view, those types of trades are always more tied to the underlying fundamental balances than sometimes the price movements are. So the types of trades that we look to do are things like U.S. crude relative performance relative to European crude and Asian crude prices. Or a big focus of ours is in the refined product space, which is where I started my career. So we have views on refining margins, which is basically the difference in the price of refined products versus the price of crude oil. All of our trades are fundamentally driven. They're driven from our balance work and from our knowledge and tracking of the physical petroleum markets.
John, what gives you an edge in comparison to other relative value commodities funds?
People often ask what differentiates us from other funds or other commodity funds, and I think that what's distinct about what we do is that it's probably more similar to what happens within an oil trading house than what happens in most funds. The way that we trade is very much tethered to what micro oil fundamentals are doing. So, we certainly have views on China or global growth, but in our view, our edge isn't in understanding those things better than the market. Our edge is understanding how the sort of microdynamics of crude and refined products are going to express themselves through time spreads and through relative value pricing. So what we try to do is take our knowledge of what the overall oil balances are, what the micro oil balances are, and then think through really kind of where I started my career, which is in how corporates hedge and how that hedging has an impact on the shape of the forward curve, and try to see if there's an opportunity to take advantage of where we see balances, where we see cash markets, and what's going on in the forward curve to put on smart, fundamental relative value oil trades.
So what are the opportunity sets you see as we sit here at the beginning of 2017?
This is a great time for relative value oil trading. As people are aware, the price of oil has undergone some pretty fundamental changes over the last couple of years. In 2014, there was a dramatic sell-off in oil prices as a result both of the U.S. production increasing dramatically over the past several years, as well as OPEC's decision in 2014 not to cut production to accommodate higher levels of U.S. production growth. The market's been trying to find an equilibrium price since then in a very volatile way. What we saw last year in 2016, very sharp declines in U.S. crude production and big increases in OPEC crude production. That dynamic changed in November of 2016 when OPEC decided to once again try to manage the market by cutting production by over 1 million barrels a day. At the same time, U.S. crude production troughed and is starting to increase. This is a very good situation for relative value oil traders because what it does is create a very strong market for areas where OPEC is cutting production, like in Asia and like for sour crude markets. At the same time, we expect there to be a very big supply response in the U.S., where capital markets are open, efficiency is growing, and U.S. producers are drilling more and more rigs every week. This creates a number of trades that we can take advantage of, both in terms of trading the front of the curve versus the back of the curve, as well as having views on the relative underperformance of US crude markets versus Asian crude markets and European crude markets. There's a number of other very good opportunities in the oil and refined product markets right now. There's a number of spec changes that are coming into the market over the next several years, the most prominent of which is going to be in the distillate market, where almost 2.5 million barrels a day of demand that had traditionally gone into the high sulfur fuel market for shipping is going to be shifting into the diesel market as a result of a spec change that's coming on to the curve. We think this is going to lead to a sharp repricing higher of diesel cracks at the expense of fuel oil cracks, and we do not think that the market is currently pricing that into the forward curve. Natural gas markets are about 20 to 25% of the overall exposure at BBL. It's always been an important part of what we do, and one of the things that I think differentiates what our business looks like relative to other businesses is that we always have a diverse set of positions on in our book. We never like to have all of our exposures into any one theme, so gas markets play an important role in diversifying our underlying exposures. The gas markets right now are very interesting. Gas markets have sold off sharply since the beginning of 2017, all the result of very, very warm weather that's been historically warm and reduced natural gas demand. The result is that prices are about 30% lower than they were at the beginning of the year. What we think the market is missing is that underneath the weakness in the weather-related demand, we've seen some very, very bullish non-weather-related demand functions. Specifically, production, which had been growing for the last 8 years, is actually declining on a year-on-year basis, both in 2016 and again in 2017. The other really important part of the natural gas equation is exports. Both LNG exports as well as exports to Mexico are picking up sharply on a year-on-year basis. At the same time, imports from Canada are flat to slightly declining. The result is that when you look outside of the weather, the gas balance is sharply tighter than it's been in previous years. In our view, as you move through the summer and you move towards next winter, gas markets are going to see very large inventory declines, and we're going to need to price significantly higher than where the forward curve is to either bring on new production or decrease demand so that the market can have a sufficient inventory buffer going into next winter.
And tell me about opportunity sets going forward.
Well, we think 2017 is a particularly good set of opportunities in the relative value oil and natural gas space. We would highlight that we view our opportunity set as being independent of the price in oil or independent of changes in price in oil. What we really require are changes in fundamental trends. So it could be a structural change in the fundamentals of oil or gas. It could be a seasonal move based on seasonal demand increases or seasonal demand decreases. And it's very, very rare in the oil and the natural gas market where something isn't going on in one of those trades, even when the price of oil looks like it's been static. So even in an environment where the price of oil may not be moving all that much, we tend to see very large movements in refining margins, time spreads, Eastern markets versus Western markets, all of which are independent of changes in the price in oil and are much more dependent on the changing fundamentals that we're trying to measure.